Corporate finance practice problem using OneNote. Internal rate of return, the IRR or Irr, uneven future inflows. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the practice problems, then down in the 1, 2, 2, 3 internal rate of return or IRR uneven future cash flows tab. Also note, when using OneNote, look at the immersive reader tool. Our presentations will be mirrored down in the text area, same name, same number, having transcripts that can be translated into multiple different languages and either listened to or read in them. Closing up the icon, we have our information up top. We're going to go through the calculations down below. We're concentrating in on the internal rate of return again. This time we have uneven payments in the future cash flows. Other than that, we can go through a similar kind of process as we saw in a prior presentation, remembering that the internal rate of return and the net present value are the two kinds of calculations for these longer term projects that do take into account time value of money, then and therefore are basically the preferred methods for those type of long-term type of projects. They are related in some ways as well, so we want to understand the relationship between them. So we have the initial investment. This is the outflow. You can imagine this to be similar for any kind of problem where you have one initial investment and then inflows at some points in the future, longer than 1 year out, therefore needing the cash flow or the cash flow assumptions, the present value of cash flows kinds of calculations. That could be investments in equipment, might be investments in some kind of project, might be investments in inventory, similar kind of processes. The cash flows that we're going to get or projecting to get, 30,000 year 1, 32,000 year 2 out, 38,000 year 3, 15,000 year 4. Cost of capital is going to be 10%. Now you might see this cost of capital in different problems as the discount rate, the required rate of return. You might hear it called the hurdle rate. This rate has in it not only basically the cost of inflation, but really what we expect our required rate of return to be. So when we think about the net present value then, if we were to present value this flow of cash flows in the future, and it came out using the discount rate of 10%, the cost of capital, and it came out to anything above zero, then we would have earned that 10% and above, and therefore possibly take on the project. So that's the first step that we want to think about typically when we're thinking about even the internal rate of return, is to think about it in relationship to a net present value calculation. And then once we have that net present value calculation, you typically think about the internal rate of return as the rate at which the net present value would be zero. That would be the internal rate of return, which would basically be your return on a percentage basis. So let's do that here. We're going to go through the net present value first, then we'll use an assumption kind of method for goal seek and just basically change the rate to then see what the result would be for the internal rate of return. Then we'll go through a calculation in Excel. Note that the internal rate of return is a calculation that is not as easy to do mathematically. So many times if you have a book problem or a test question, they might not be able to have you calculate it directly, but ask you kind of relational questions about it. In practice, you have Excel to do it, which makes it quite easy, and it is a very, very important tool to understand conceptually. So let's do first our present value calculations. So the first thing that we would do is take our information up top. I would put it into a table such as this, representing each year starting with year 0, that being the initial investment. The initial investment's going in as a negative number, listing out then the number of years and the investments for those years and the positive flow numbers, those being uneven investments, but that's okay. If we total that up and we're not taking into account present value of money, we'd be at the 25,000 basically gross income. Then we'll present value each one of them. I'm not going to show it mathematically or even the formula in Excel. We're going to assume we just kind of do it in Excel. We're using present value of 1 calculations. Note that we can't really use any other present value of annuity calculations in this format due to the fact that we have different cash flows in the future. So again, a book problem that restricts you from not using financial calculators or a computer would have a difficult time asking you a full question to calculate a long problem that has different cash flows in the future to make you do it with a formula. But conceptually, you want to know that, and in Excel, it's fairly easy to do if we use the present value calculations. We do these in Excel, so take a look at those when you have time if you want to learn more about the Excel item of it. So if we were to present value the 90,000 at period 0, of course it would be 90,000. If we were to present value the 1 year out of 30,000 using the discount rate, the cost of capital of 10%, then it would be 27,273, obviously lower. Then we have the 32,000 here. If we were to present value it 2 years out now at the discount rate of the 10%, it would be 26,446. If we took that 38 3 years out, present valued it at the 10% discount rate, we're at the 28,550. And finally, 4 years out, the 15,000 discount rate 10% gives us the 10,247. Adding up that series of payments, we get to the 2,514. Now note, when we use the term present value, it could be a little bit misleading because you're tended then to think that this 2,514 is basically our current value, taking into consideration maybe you're just thinking like time value of money. That's what I used to get mixed up on. Maybe they're just talking about the cost of inflation. So I'm really only getting in today's dollars 2,514, but that's not really the case because generally this cost of capital includes in it our required rate of return. It's the hurdle rate. It includes the rate of return in it. So if anything above 0 happened over here, that means we cleared our hurdle rate, the 10%, and therefore it might be something that we would then accept. So even if this was 1 down here, it might be something we accept because we are getting a return. We're getting, the 10% return, which is built into this present value calculation. So then the next question would then be, well, what if this is 2,514? That's great. If I want to compare it to other projects, it might be useful for me to compare it on a percentage basis. So note that this number, the bigger it is, the better if I was to compare it to another project, but I might want to know what the percentage return is. So the question then is, what rate would this be in order to make that number 0? So we could do that with trial and error, right? We could take our goal seek here and say this 10%. I want to change that 10%, continue to change it until this number gets to 0. It would need to go up considering the fact that we still have a positive number at the 10%. So I could try 11%, 12%, and so on till that gets to 0. We can do that easily with Excel with a tool called Goal Seek, which would do that for us. And if we were to do it, we'd get 11.37, and that would be the internal rate of return. The internal rate of return then being the number at which this series of payments, when present valued, ends up with a result of 0 at the bottom line. So we do that in Excel. If you want to test that out, that's one way to do it. Basically trial and error, goal seek in Excel, kind of allowing us to do that quite quickly. Then also in Excel, you have the IRR formula, which you can do as well. In order to do the internal rate of return formula, you still need to set up your cash flows properly, meaning outflows negative, inflows positive for your periods that are going to be involved. Once you have that set up properly, you can do your formula quite easily. Equals the internal rate of return, the IRR, brackets, and then just take this series of numbers from the 90 down to the 15, which is kind of like the sum function. It's kind of like the sum function with the IRR instead of the sum function. And that would then give you that 11.37 as well. This is a nice fast way to do the internal rate of return, but when done this way, many people don't really understand what the internal rate of return means. By plugging that rate back into a present value calculation in this format, actually looking at the present value of each of the time periods, instead of, you could use a present value formula or function as well too, which we'll look at in a future presentation. But that one to me is less useful because you still need to set up the table, and you might as well just look at the present value for each period if you're going to set up the table anyways. But we'll look at that in the future. Point is that you want to be able to then calculate it with the net present value so that you understand the relationship between the internal rate of return and the present value. That's the important concept that you want to have down, understand, both in terms of test questions and in terms of practice. It is an important concept.